Hello, everybody. Luke Gromen, FFTT. Hope you had a great weekend. It was the first beautiful weekend of the year here in Cleveland, 80, 85 almost. So very nice, but being that it is Cleveland, it's going to be a high of 41 by Wednesday. So that's how we roll up here. So I'm going to jump in right into the questions. Thank you, everybody, for submitting them. Let's look at a few of them. From Brendan, you are reading the same Fed statements regarding 50, 75 basis point interest rate hikes. Yet your argument is the U.S. is in no fiscal condition to pull that off. It seems crazy. All people are looking at the same numbers, that more than one option could exist. No? Yeah, it does seem crazy until to me, and I'm going to be a little direct and a little tongue-in-cheek here, the same types of people, if not the same people outright, were arguing for rate hikes in August 2019 to help get Trump out of office, just 3 weeks before repo rates spiked, just 3-4 weeks before the Fed's balance sheet began growing again. The Fed at that point had already cut rates once, and yet they were talking about raising rates for political reasons. Same types of people were arguing in 2002 that the label of Afghanistan as the graveyard of empires wouldn't apply to the United States. The same types of people were arguing that subprime is contained. And so my point is that I see the people arguing that they're going to get these rate hikes and completely ignoring the context of the U.S. fiscal situation. And I can only think of Upton Sinclair's famous quote, which is that it is difficult to get a man to understand something when his salary is dependent upon his not understanding it. And I think that's exactly what's going on here. From George, humans like clean narratives on why something is happening versus accepting the randomness of decisions being made and their outcomes. How do you weigh nation states making strategic decisions versus simply responding to action that in hindsight was a miscalculation, i.e. Russia and China? The way I think about it is long term, it's pretty clear what various nations' strategic interests are, particularly vis-a-vis their sovereign debt and fiscal financial positions. And then once we understand that, you start to adjust the sails in terms of where the ship is sailing relative to those long-term strategic interests. And then I try to focus on analysis where, I try not to focus on analysis where I have to guess if there's a miscalculation or not. Sovereign debt is in a position where there can basically be no problems economically in the world anywhere ever again. And so, whether or not what has taken place was a miscalculation, the math is the math. And so once we get to that point, then it's about risk management, understanding the path between here and there, the potential path between here and there, the range of outcomes, and by that I mean deflationary episodes. How do we hedge that, and then how does that in turn change the pace at which we are arriving what is very highly likely to be the end game, which is yield curve control in the U.S. globally, really, as a result of sovereign debt levels. From Tumish, I hold commodity stocks, gold miners, gold royalty, uranium, Canadian oil producers, etc. I also have gold and silver. Should I try to lower my risk or not? I guess what I want to know is if markets implode, am I overexposed holding a lot of stock? I think it depends on your time horizon. If you're under 2 years, under 12 months in terms of your time horizon, yeah, I think there's real risk. If you have a longer term time horizon, 2 to 5 years, then no, I don't think there's a lot of risk in that position based on the sovereign debt being in a position that, again, there can be no problems anywhere ever again. We have a problem, and from there it's about risk management, and between here and there, again, deflation, and then how long till the end game with yield curve control. So I keep coming back to no country with a fiat currency that I'm aware of has ever defaulted on its sovereign debt for lack of printing money. So again, I think it's all about that risk management. And I think right now, quite frankly, we're in a period of time where you need to be aware of your risk management. I don't think you want to be too far over your skis holding commodities, gold, etc. We've been writing a lot about that in terms of max defensive position, talking about raising cash for months now to be in a better position, give yourself optionality, hedge volatility. From Karoshi, why aren't we seeing spreads widening in the corporate bond market? Why aren't bond managers worried about credit risks too much? Because the risk is in sovereign debt. It's in the sovereign debt market, and therefore the risk is in duration, i.e. inflation risks. And so, in my view, credit is going to follow duration. Inflation up, rates up, credit problems. Next one, a big theme in your work, and this is from a couple people, big theme in your work is that government needs to issue more debt to stay solvent, and that the natural buyer is disappearing, forcing the Fed to purchase more of said debt. What if the government instead forces native savers to purchase the debt, i.e. sort of like Russell Napier's cap day, where you're forcing domestic audiences to buy at negative real rates? The issue with that, I think, number one, we've already seen some elements of that with bank HQLA regulations, money market fund reforms. They're forcing to buy treasuries for regulatory reasons. The reason I think it's a problem, why it won't work, is the U.S. consumer is 65% of GDP, consumer spending. And forcing consumers and the private sector to buy negative real rate debt is effectively a tax hike. And that hurts the consumer, that hurts GDP, that sends tax receipts down, that sends treasury issuance up, and now you need to have them buy more negative real rate debt. Wash, rinse, repeat until you go into a death spiral, a debt spiral. So for me, because of the U.S.'s twin deficits, the only way out is the Fed buying a quorum of that debt. And then the final question from Invalar. Mike Green, when asked, when asked what is currently a good investment for your average Joe to protect net worth, said there's really nothing, and Joe should invest his money into skills and certifications that allow him to earn more net worth. Is it really that bad? Depending on the time horizon. In the short term, there's not a lot that looks really attractive right here, given the deflationary policy mistake policymakers look likely to be embarking on, led by the U.S. Beyond the very short term, though, I think, again, secular inflation is needed to stave off sovereign defaults. I agree either way, short term or long term, with the skills side. Between the internet and then also what is already beginning and is likely to get worse, trade skills shortages, I think there's a secular trend toward basically scalping big, slow-moving corporations with either your brains via the internet or your trade skills on the ground. I think that's going to be a big theme for coming years. It's something we've talked with our boys who are in their teens and early 20s, as just that entrepreneurship really wins over the next probably decade plus. So with that, I'm going to sign off for today. As always, thank you very much for your questions. For more information about what we are up to, check out FFTT-LLC.com. Like I said, more information about what we're up to, as well as our more information on our tree rings product, 10 most interesting things, brief synopsis on what grabbed our attention about it, whether it ties into something we're seeing or refutes something we're seeing. So with that, everybody have a great rest of your week, and we'll talk to you soon. Take care.